Take a look at this time lapse of a rushing river. This is exactly what happens to market volume every day. The New York session closes with high momentum, but as the Asian session opens, it hits a flat basin and volatility instantly drops. From 11 p.m. to 8 a.m. GMT, the market slows to a crawl. Retail traders look at this period and see nothing but frustration. Price action moves almost entirely sideways, locking into tight, compressed ranges that offer very little room to maneuver. They try to force standard daytime strategies into this environment. They watch for a breakout, take a position, and then immediately watch the price reverse, chopping their trade to pieces. Applying high momentum tactics to an overnight market guarantees poor results. Retail traders routinely act as unwilling liquidity providers for larger participants. That tight sideways price action is completely intentional. Institutions use this low volume period to execute an accumulation phase. This diagram shows how that phase operates. Institutions build what are called liquidity pools, massive clusters of buy and sell orders carefully stockpiled without disturbing the actual market price. They place these pools precisely at the extreme upper resistance and lower support edges. To survive this session, you have to stop looking for a trend. Instead, you need to look for where these hidden order traps are being set up. A quiet market is an active construction zone. Institutions are methodically laying the groundwork to capture retail orders. The first step in trading this environment is ignoring major pairs like USD/USD, which routinely flatline overnight. You must select assets anchored in the active region. Pairs with direct ties to Asia-Pacific economies provide the baseline volume required for clear market structures. This financial dashboard isolates the ideal targets. We look straight to AUD/USD, NZD/USD, and cross pairs like AUD/JPY. Filtering out the stagnant European and US majors leaves you with pairs that clearly display the predictable, institutional-driven patterns necessary for a smart money strategy. Institutions capture orders on these pairs using a tactic called inducement. They create deliberate, false signals to manipulate retail sentiment. Look at this chart. Price pushes slightly above the resistance line. Retail traders read this as a valid breakout and rush to buy. They place stop-loss orders just behind their entry. Notice how these individual markers merge into a massive, concentrated target zone. The textbook breakout was a complete fabrication. It was engineered specifically to group retail stop-loss orders together so smart money could target them. The prime opportunity happens between 00 and 02 UTC. This is the kill zone, where the Tokyo and Sydney markets overlap and inject volume. This animated chart illustrates the resulting Judas swing. A violent, deliberate price sweep drops below the range, sweeps up that entire cluster of retail stop-losses, and then violently reverses upward. If you enter during that initial spike, you'll be liquidated. You must wait out the violence. Zooming in post-reversal, your actual entry trigger is here, a structural break of the previous high on a 5-minute chart. Letting the Judas swing clear the board and waiting for that structural confirmation aligns your trade directly with institutional momentum. Operating inside this compressed market requires strict risk recalibration. You have to drop the expectation of capturing a massive 100-pip run. The primary defensive adjustment is tightening your stop losses down to an ultra-narrow 5 to 10 pips. Take profit targets must also shrink. You aim strictly for internal liquidity gaps or the nearest unmitigated supply zones within the existing overnight range. Profitability here relies on executing highly precise, high-probability strikes within a compressed space. A tight 20-pip range is essentially a coiled spring. Smart money is building leverage to prepare for the heavy volume of the incoming London Open. You cannot execute a strategy requiring 5 to 10-pip margins if your broker introduces friction or slippage. Executing these precise strikes requires the ultra-fast execution and 0.0 pip sprints offered by FXNX. Open a demo account today and start tracking institutional traps in the